All right. Hello, everyone. John Cook here, Senior Investment Analyst at iSectors. Thank you very much for joining our webinar. Today, I'm going to be giving a brief overview of the second quarter performance for all the iSectors models. Just one quick note before we begin, though. Starting this quarter and going forward, all the performance I quote today and everything listed on our website and our marketing materials is being reported net of iSectors standard management fee. Everything, it had been all gross before that we quoted, but going forward, it's going to be all net. So just keep that in mind as I walk through the report here. I'm not going to be sharing any full performance data on the models. I'll just be kind of going over everything briefly. But if you want anything in more detail, we always have performance reports available on our website if you ever want to take a deeper look at any of our models. This call is going to last about 20 minutes today with a short question and answer segment at the end. You can feel free to ask any questions during the presentation by clicking on the chat box in the lower right-hand corner of your screen. The webinar is going to be recorded and a copy will be available on our website within the coming days. You can just click on the iSectors blog icon under the Editorial and Media tab, and it'll take you to a link to access the recording. We're also going to be sending a replay link to all the webinar attendees who attended live immediately after this call is over. So with that being said, let's get started in earnest. After solid outperformance in the first quarter, both iSectors post-MPT moderate allocation and the iSectors post-MPT growth allocation underperformed their benchmarks in the second quarter. So far this year, though, growth has outperformed the S&P 500 by about 5%, down 15% compared to a down about 20% for the S&P. Moderate has also handily outperformed both the S&P 500 and its 60/40 stock bond benchmark, only down about 8.5% so far year to date. Returns for this quarter, though, were most negatively affected by energy and gold exposure, which is actually what had helped boost returns for both models during the first quarter. Looking ahead, though, both models implemented similar trades going into the third quarter at the beginning of this month. You can see in the chart on the right that both models decreased their allocation to quote unquote what we call alternative stocks, which also happen to be the most inflation sensitive asset classes we utilize, as you can see in the note at the bottom: real estate, energy, gold miners, basic materials. A big portion of that was in energy and gold miners, which was reduced in both allocations. Both models also added large healthcare positions in an effort to get a little bit more defensive. That's most noticeable in post-MPT moderate there, where the traditional stock sectors went from 7% to 24% compared to a couple months ago. In growth, it was mostly a pivot out of technology into healthcare. Again, highlighting getting more out of more growth-oriented sectors into more defensive sectors. Both models also added to treasury bonds, growth more so than moderate, because as you see, again, it previously had very little bond exposure, as it was more focused on some of the inflationary pressures in the economy and wasn't hedging as much against possible recession indicators, which post-MPT moderate had been doing beforehand, before this quarter, I should say, and growth kind of pivoted that way a little bit more now. And as those recessionary pressures in the economy continue to increase, with Powell actually just saying today that executing a soft landing is going to be even more challenging than he thought in recent months, having this a little bit more of a defensive exposure with higher allocation to bonds is where we like these models right now. Moving on to another chart about our post-MPT models and a little talk about diversification and correlation. The chart on the left shows Morningstar style box asset classes: large value, large growth, small value, small growth, etc., and their correlations to each other and amongst each other. And you'll notice how so many of those asset classes, how close that correlation number is to 1, indicating almost perfect correlation. And this is over the last 5 years. This has kind of been happening in years more recently, over the last 5 than others. The chart on the right, though, shows the asset classes we utilize in the post-MPT universe. You can see the cross correlations there amongst each other, how much lower those correlations are to each other over the last 5 years. So in times of uncertainty, such as those we're living through right now, when consensus views change every day and no two pundits have the same opinion on the Fed, interest rates, or the market in general, diversification using asset classes with low correlation to each other is the best tool we have for asset allocation and building portfolios. And I think maybe an overly simple explanation, a story, might be the best way to illustrate this point. So think of a New York City street vendor that only sells umbrellas. He decides to diversify his business, thinking, well, I really don't make much money when it doesn't rain. So he decides to sell umbrellas and raincoats. Has he diversified what he offers? Yes. But has he reduced his risk of not making money if it doesn't rain? No, that stays the same, even though he diversified. Think about though, what if instead of diversifying by selling raincoats in addition to umbrellas, he decided to sell sunglasses? What would happen then? Has he diversified? Yes, just like the first scenario. But has this diversification reduced that vendor's risk of not making money? Yes, it has reduced his risk because now he can also make money while the sun is shining or when it's raining. We like to tell that little fable. It's a good reminder that it's impossible to be prepared for every single scenario, but we think using the asset classes listed in the chart on the right there is a good starting point that gives us a nice head start when creating portfolios for clients. Now, moving on to our more traditional equity models. The iSectors domestic equity allocation has outperformed the S&P 500 both in the second quarter and year to date, only being down about 11.2% for the quarter versus the S&P's 16% loss. Our global equity allocation has also outperformed its benchmark, which is the MSCI All Country World Index, in both of those periods, this quarter and year to date. Both of these strategies were mostly helped by domestic quality dividend focused ETFs, such as the Spider S&P Dividend ETF, SDY is the symbol you see on the right there. It tracks an index of companies who have raised their dividend for 20 consecutive years. So in the chart, you can see how funds like SDY is just an example of one of the ETFs we utilize in our model. That's a quality dividend focused ETF. You can see the growth of funds like that compared to the Vanguard Growth ETF, VUG, which is a large cap growth ETF. Since the beginning of the year, those dividend focused funds have really outperformed. So our crypto block suite of models now, the iSectors crypto block allocation and the iSectors crypto block 2 allocation both struggled this quarter and have been struggling year to date, frankly, mainly driven by the declining price of Bitcoin. There is hope, however, as Bitcoin has, and actually you see in the chart here, I have rebounded back above $21,000. Actually, just this afternoon, it rebounded above 22,000, close to 23,000 as I was preparing the presentation. And it rebounded up to that high, well, the recent high, from its recent low of right under 19,000. And in talking about the two models, CryptoBlock 1 gets direct Bitcoin exposure through the Grayscale Bitcoin Trust, while CryptoBlock 2 only uses equity-based ETFs to gain adjacent exposure to Bitcoin with a heavier focus on just blockchain technology and the companies that utilize blockchain technology. You can contact us for further details on how to access those strategies if you're interested, because they have limited platform availability. Moving on to our fixed income models, the iSectors fixed income allocation continues to outperform the Bloomberg Ag benchmark year to date and over the last 12 months. And our global fixed income allocation is also doing the same versus its FTSE World Government Bond Index as well. What's really driving a lot of this outperformance is the shorter duration profile of both of these models against the indexes, which are a little bit longer duration benchmarks. You can see in the chart on the right there, domestic fixed income is almost a third of the duration as the Bloomberg Ag, and global fixed is just over half, a little bit, maybe like 60% of the allocation of the duration of the World Government Bond Index, which has done enough to help it outperform. And I should also mention, global fixed also has more domestic exposure. It does still have international bonds, but it's all U.S. dollar denominated, and that's why there's been a outsized outperformance in our global versus the World Government Bond Index, even though it does have a little bit higher duration than our domestic fixed. Okay, on this slide, the iSectors Enhanced Balanced Allocation is going to serve as a proxy for our entire Enhanced Allocation series, just because they kind of are all made up of the same thing. These models are blends of our other previously mentioned model offerings: domestic equity, domestic fixed income, and post-MPT growth. All 5 models in the series, ranging from conservative, which income is our most conservative, up to aggressive, have a 20% satellite allocation to post-MPT growth, with the allocation between domestic equity and domestic fixed income varying based on risk level. Enhanced Balanced, it outperformed its Morningstar Moderate Target Risk Index in the second quarter and over the last 12 months as well. The main reason for this is because it has less international exposure than its Morningstar benchmark. And part of that, the reason that we don't have as much international exposure as the benchmarks is because, based on our research, the large multinational dividend-paying companies that we utilize in our domestic equity allocation, they derive about 40% of their revenue from international and emerging market companies. So that's why we stick to using domestic equity instead of global equity in the enhanced series. Okay, onto inflation protection. The iSectors inflation protection allocation lost about 7% in the second quarter, while the iSectors precious metals allocation decreased by about 12.5%. Even after recent pullbacks in commodities and precious metals, which is the reason for the negative recent performance, inflation protection remains positive over the last 12 calendar months and is the best performing iSectors model over that same time period, mainly due to the mixture of the commodities and precious metals, like I mentioned, and also short-term tips have performed very well for the model this year so far. Going into the third quarter, we did make some slight tweaks to the inflation protection model, though, as you can see in the updated allocation pie chart on the right. The most notable addition that may stand out to you is a 5% allocation to a Bitcoin futures ETF through the ProShares BITO. BITO is the symbol. We aren't doing this as a short-term market timing position or anything like that. We view this as a long-term holding that we plan to keep for many years, as fiat currency is only going to become more and more unreliable as time goes on. Moving on to our liquid alternatives allocation, it underperformed its hedge fund benchmark in the second quarter and over the last 12 months. One of the main reasons for that is because of alternative equity and real asset exposure. The real assets kind of like has been a theme that energy and precious metals have had poor performance this quarter. One thing that did help the model a little bit, though, was a hedge strategy positions it has, which you can see in the pie chart. It's about 38% of the allocation of the model. This includes things like long short commodities, merger arbitrage, managed futures, among other things like that. They helped from keeping losses being too bad this quarter. Our endowment model, it's a high income focused model that it outperformed its benchmark both this quarter and over the last 12 months, the iSectors endowment allocation. The high income of the model is what really helped to buoy returns, with high yield fixed income being one of the most, I won't say positive, but least negative contributors to return in this most recent quarter. It has a yield over 5%, and so this model could be an excellent solution, actually almost 6% now. This model could be an excellent solution for clients more focused on current income than total return, which we've had advisors asking us for that before. So there are some clients like that. The iSectors Tactical Global Balance allocation outperformed its benchmark in the second quarter, year to date, and over the last 12 months. The conservative positioning of the model continues to be the biggest reason for its outperformance versus the benchmark and its outperformance versus most of the rest of the models that we offer. The most recent positioning can be seen in the chart on the right, and this, you may note that there's an 84% position to short-term bonds, which is our cash alternative. Short-term bonds and notes, actually, we use some floating rate notes as well. This is the closest that I've seen the model ever being to 100% cash. We talk about that very often, that this is our one model that has the ability to go to 100% cash if the market, is unfavorable and all the underlying asset classes deem that fit. And this is the closest I've ever seen it. So that's just kind of commentary on the current market environment we're in, given all the different types of asset classes we use in the underlying for this. And just as a reminder, the way we choose those asset classes, it's a momentum-based trend following strategy, and it can invest in the handful of asset classes you see here, along with a couple others, some international asset classes. Um, and like I mentioned before, it can go to 100% cash and not be invested in any of those asset classes if our signals indicate that should be the way it is. And last but not least, our capital preservation allocation. It had negative returns this quarter and underperformed its benchmark by about 50 bips, which is again net of fees. That's important to mention for a lower return fixed income type vehicle like this. You can see the portfolio composition on the right. That kind of is an example of the type of exposure I'm talking about here. That's where we currently stand today. That can change sometimes. The duration that I note here, 1.4, it's been a little longer in the past. We'll move it a little bit based on the market environment, but given where we are now with interest rates, we like the very short duration we have of 1.4. Compared to cash, the yield is pretty attractive. The duration is, as you see, is shorter than we showed previously our other fixed income models and a lot of the other core bond type of strategies you'll find. And that's helped to protect against rising rates this year. It has outperformed our other fixed income models that I touched on earlier, mainly due to that, the duration and the higher investment grade rating. Okay, and as you read through the disclosure page, I will remind everyone once again that full return data is available upon request or on our website. In the past, we've even run custom blended reports of our models, so don't hesitate to reach out today to myself or Scott Jones, as you can see our contact information here. If you have any questions about custom reports, like I said, or any other specific questions about models or certain historical time periods, we can help fill in any gaps that you may have in knowledge about some of our models. Okay, now with all that being said, we can start the question and answer portion of the webinar. I'm going to look here and see what we got. Okay, one question I have, go back to the capital preservation. Yeah, the duration is kind of hidden here, 1.4. I'll try to highlight it here. Can put an underline on it with the new. There we go. Okay, there. So 1.4 duration for capital preservation. We can compare that to our other fixed income models I showed before. 2.1 for domestic fixed, 4.87 for global fixed. So capital preservation is it has a marginally lower duration than those other models, which that's why we kind of separate it out into its own slide here, because it is a different beast than our other regular fixed income models. Okay, at the moment, not looking. Oh, here we go. One more question. That's good to see them filtering in here. The inflation protection returns, we can go back to that. Yes, that is a good idea. Because as I said before, it's our best model over the last year. I'm going to pull up the exact numbers here just so we can know. So the positive returns, it is over the last 12 months, it is up about 0.5%, which anything in the green we'll take. And then during this quarter, like I said, it was down about 7%. So before this quarter, it had been up quite a bit. And before the quarter, it was our best performing model. And now even after the quarter, it still is our best performing model, even after being down 7% this last quarter. So good to highlight that again. And as you see in the title, it is protecting. It's the best model we've had so far, at least that's protecting from inflation. That's why we named it what we did. So, okay. Go back to the contact page just so you can see our contact information one more time. All right, so with that, I want to thank everyone who attended our webinar this afternoon. And if there's anything else we can do to assist you with your wealth management or asset allocation needs, please let us know. If you have any questions we didn't get to, we can be reached directly by phone at 800-869-5184. Have a great day, everyone.